All right, this webinar is being recorded. Thank you very much for coming. I'm Holly Corcoran, CPA, and my guest is David McCormick with Simmons Inc. We're going to be talking about valuation, veterinary practices, and operational KPIs. I'll be talking first for about 15, 20 minutes, and then David will take over from there and leave the last 10 minutes or so for questions. Please feel free, whatever questions you have, to put them in the Q&A, and we will go through them at the end. If it's pertinent, I'll try to interrupt and see if we can answer them as we go. But at the end, at the very least, we talk. Again, I'm Holly Corcoran. I'm with Corcoran Business Advisory Services. I owned and operated a traditional CPA firm since 1991 to 2012. I partnered with another local firm. And then in 2024, we sold that. And I have since then concentrated on advisory services, financial services, and advanced tax planning for veterinary practices. I come by it honestly because my daughter is an equine veterinarian practicing in Pennsylvania. I have lots of friends that are vets. I've worked with a lot of vet clients. And I also ride endurance step riding, which is judged by veterinarians. So I'm surrounded by them. I figured this is a great opportunity, and I love working with veterinarians. So happy to share my knowledge, and we'll get started. So what I want to do is talk about the nuts and bolts of actually being ready to have your practice receive evaluation, because what David needs to work with are good numbers to start with in order to be able to come up with a good, accurate valuation. And accurate records, financial records, are very important for you on a day-to-day basis. Without timely records, you're going to be making decisions in the dark, and perhaps you're not monitoring your practice as you could, not making good decisions, not taking opportunities of things that may arise as you're going through your practice. And think of it this way: as a veterinarian, when you have a pet or animal that comes in, or you're in the field doing diagnostics and you run, say, lab reports, and you get them back, and you're talking to the pet or animal owner, and you're going through the diagnosis and the potential treatment. If for some reason those labs were not done appropriately, you wouldn't be relying on good information to be able to provide the diagnosis that you need. And the same is true, you have some pet and animal owners that don't want to go to the expense of it. And again, it interferes with the patient, and we want to make sure that everybody's getting the best care, whether it's you providing the help for your pet and animals, and us providing the advisory services for the business. In addition, on a practical basis, it helps you manage cash flow, control costs, and make good hiring decisions as you go through the month-to-month, year-to-year growth and changes of your business and the cyclical stages that you'll go through. And it's really critical when you go to seek a business valuation, because what's going to happen is the valuator is not going to just look for your tax returns. And I think that's an anomaly or misnomer that some people have, that I'll just give them my tax returns. And David and I were talking earlier today, or yesterday it might have been, that he's received the green ledger sheets, which I'm aware of as a CPA with a couple years under my belt. But any type of manual records and so forth is just by the wayside at this point. It needs to be automated, it needs to be accurate, and it needs to be timely. And that's the next point: is timely reconciled monthly financials. What that does is not only necessarily make sure that all of the numbers are in the right place and that they are accounted for, it allows better comparatives because of cutoffs. I've had situations where I had individuals that felt that their records were in good shape. We went and started doing data comparisons from month to month, or whatever period to the other. And it was just widely various because of the lack of timing, having things fall in the wrong month, and not having good comparatives. The other thing is accurate revenue expense categorizations, as well as your balance sheet. And I just make you aware of here, using the AHA chart of accounts is a good idea. I provide the link in the slides that will take you to all of the resources available through AVMA. And here is actually an example of what the chart of accounts look like. That's for the balance sheet and for the profit and loss. And you can get down and drill down into quite a lot of detail, which is great, especially if you have a larger practice with lots of bells and whistles and things happening at various different levels. You want to make sure that you are identifying your expenses to the best advantage so you can make really good, accurate comparatives and decisions. But you may be in a situation where you don't necessarily need that level of detail. And the AVMA provides an example of what it would be to use an abridged form of their chart of accounts so that you have an understanding of what the higher level numbers are. And you can also get this to work with the financial program that you employ so that you can look at the higher level and see what the numbers are and not necessarily get really tied into the weeds of the financial statements. But know that you have this access and information that's available right through AVMA. The other thing I want to talk about is solid, good accounts receivable aging. That's what AR aging is. Clean up lingering balances. I've gone in and seen accounts receivable aging reports that just are not accurate. One, you want to make sure they're accurate and any outstanding balances are correct. That payments received were applied to against the right invoices, that there might not be duplicate invoices out there. Or the other thing you want to monitor is 30, 60, 90 days. If it's over 90 days, are you employing an agency or somebody, or maybe internally doing collections on those old receivables because they're not doing you any good sitting out there without getting paid. The other side is the accounts payable, which doesn't necessarily so much affect your valuation as much, but the accounts payable, I've seen it where the payment was made, the bill is still sitting in accounts payable, and you want to make sure that these type of items are cleaned up for financial statement purposes, for valuation, for whatever purpose it may be. And the other thing is your cost of goods sold and your inventory. And I know the inventory really is handled a lot through the practice management software, but you want to make sure that the electronic number that you're coming up with through the practice management software is accurate. You want to do periodic spot checks. I know that some practices I've worked with have counted monthly certain items, areas where there's maybe concerns, larger ticket items, maybe your DEI, you want to make sure you keep DEA, you want to keep, I said the wrong acronyms in there. You want to keep a really close eye on that. But those, you want to make sure that the electronic records agree to the physical count. And at the end of the year, you absolutely want a physical count. And for financial purposes, absolutely. And I'll tell you, as a tax CPA, you also want to make sure you have that for the IRS because they're going to look at that when they come in if they were to audit the tax return. You want to document your owner's compensation. Absolutely all of your employees. You want to make sure everything's well documented. But the owner's compensation, we have a little bit more flexibility with and may want to accomplish different goals. We want to make sure that we have that well documented so that the evaluator knows what the numbers are that we're working with. And then just go through the day-to-day benefits. I can't stress it enough that if you have good financial data, you can use it now. And David will be talking about how frequently and when you should be having a valuation. And in between, there is a gold mine of information that's in your financial data that really should be gleaned and used. So you want to know what your margins are, what your profitability truly is. You want to avoid surprises. I'm a huge proponent of making sure we plan well in advance, doing tax planning to, on a quarterly basis. What I do is I meet with my clients on a monthly basis, but on quarterly, we look at the taxes and say, hey, where do you stand? Do we need to pay in? Are there areas where we can take advantage of more savings on the entity level? Or, is it something that we can do payroll bonus to be able to catch up on withholdings, but we also want to weigh that with the financial end results to make sure it makes sense. And cash flow shortages. I have a wonderful dashboard that works with, taking the actual data, looking against our forecasted data, and extending it out to say, hey, this is where I think we might run into a cash flow shortage, or hey, we're in good shape. Maybe we should start building a reserve. And though that information and having good records will also make your lending opportunities better. You'll be approved for financing easier. It'll help your credit rating, but also, um, you want, if you're looking at cash flow shortages, do you have a line of credit in place? Are you looking to finance equipment? You want to make sure that you have yourself well positioned to make sure that you're not shooting yourself in the foot to be able to do the things that you need on a business basis. And you, of course, want to make informed decisions for staffing. Do we need to increase our prices? Do we need to keep them the same? Where do we stand in comparison to the market in the area? Hey, I'd love to buy that really new fancy piece of equipment, but what's the ROI on it? We definitely want to take a look at that. And I know that these items may seem overwhelming to practice owners and sometimes the practice managers when they're working with the owners to say, hey, this is a lot of stuff. But I can tell you, if you work incrementally to put these pieces in place, it actually does reduce your stress and you have more control over your numbers and your practice on many levels. So I want to talk about KPIs, which are key performance indicators. And it's basically the percentage of this to that. But what I want you to think about is a lot of times the KPIs that you use are meaningful for what you are trying to track. And it's also sometimes I find more meaningful when you can look on a comparative basis within your organization and say, this is the benchmark, this is where I want to go, and these are the percentages I'm shooting for in my practice, in my demographics, in the type of practice that I have running. But in general, I just wanted to throw a couple numbers out there. Payroll, a lot of times we look at 20% for non-veterinary staff as a percentage to revenue, 20 to 22% for veterinary staff. And that's average. Again, if you have a different, size revenue stream, or you're growing, or you're in a different stage in your practice, those numbers are going to be different. The gross profit margin, that is the number where you take your revenues minus your cost of goods sold, and you look at that as a percentage of the revenues. And you want to be around, 65 to 75% in small animal practices. Large animal is going to be around 50 to 60%. And the net profit percentage is really at the bottom line. You took your revenues, your cost of goods sold, you take your gross profit margin, and you take all the remaining expenses out of there. You come to your net income. And that is a percentage of your revenues, which for small animal practices tends to run 10 to 20%, large animals 8 to 15. And, in reality, it's usually somewhere in between. And again, it's going to be specific to you and your practice. I mark in here that EBITDA might be a more meaningful, which is earnings before depreciation, interest, taxes, and amortization, because it looks more on a purely profitability basis when you don't take into those variables, because some practices may not have interest because they've paid out of pocket for all of their equipment. Some may have little to no depreciation, or a lot of depreciation, depending on the lives of the assets, and it can influence the net income, where EBITDA might give you a better view. And again, this can be influenced by owner compensation and other practice goals. So we always want to keep those in mind when we're looking at the numbers, and don't look at them in a vacuum. The other thing from your practice management software, and again, this is going to vary by your practice, your specialty, and your demographics, but we want to look at revenue by doctor, perhaps average client transaction, or maybe average invoice. We want to look at the active client count. How many do we have in the system? Many of the software now will track as a patient is, going beyond their routine care, and maybe they're falling off as a patient or a client, and allows you to follow up on that. New client acquisitions and client retention. And some of these too can also be done with surveys to say, if you have that patient that's dropping off the rolls, you can reach out to them and say, please come in for your routine care. If not, how can we help you better, or what made you make choices to move in a different direction? and keeping a healthy dialogue with your clients and with your even your employees. You can use surveys too to find out where people are at, and see measure those to see whether you have a good healthy client mix, and you have a good work environment. But we're not going to go into that in great detail here. So overall, your accurate records, help support more meaningful KPIs, because if things are in the right buckets, it helps you make better decisions. You can't manage what you can't measure. Garbage in, garbage out, just like any type of, we always talked about that with the computer. Everything's on the computer now, so it's got to not be garbage in. You want a consistent monthly close. That's what I was talking about before, where we actually literally can make meaningful decisions between months or periods. Coding is important. If things are coded in different places for a different month or whatever, that can throw off our numbers. And poor record keeping can impact you making the wrong decisions. So in other words, sometimes it's going to be very helpful in helping you shoot for the right decisions, but sometimes you can have a misleading report and use it to make decisions that do not help your practice. And finally, I want to kind of jump in and talk about the building. David's going to talk about the valuation of the overall practice and how a building is going to come into that equation. But just to give a heads up on some of the things that you want to keep in mind when you have a building in the equation. Either you're buying an existing practice that has a building as a component, or you're in a position where you're looking to buy a building, or you're just starting out, you're buying a building and starting to practice. However it is, I want you to talk to your attorney and make sure that, do you have that building in the right place? It should probably be a separate entity. I suggest an LLC, but your attorney will guide you in that process, because they're looking at liability protection. If you're sued on the corporate level, they can attach those assets in the corporation and so the practice is one entity, and they could attack those assets. But if the building is held late, it's a good chance that will be insulated from any liability. But I'm not an attorney, so I always say to talk to your attorney. And there are tax savings too in using the separate entity, and that's where the lease comes in. And I talk about structuring a triple net, which is, the practice pays the entity holding the building a rent, and also pays for common area expenses, real estate taxes, and insurance, because this is putting it in the area where it's taxed a different place on the earned income versus passive income. I don't want to get into the details of that, but it just take my word for it that it does actually end up helping save tax dollars when you have it in the right bucket. So how owning a building will affect your valuation, I'm really going to let David talk about that, but I do want to make sure that you're aware of where that building should be in the process. And this is my conclusion. Accurate records make for a stronger practice. Timely reconciliations and KPIs, and work with professionals, vet professionals that are working with you on a day-to-day, month-to-month, year-to-year basis to help stay valuation ready. As I said, Dave's going to talk about the whens, whys, and all ins and outs of getting your practice valuated, how frequently you should be doing it, and for what reasons. And so please make sure your questions go in the Q&A, and we will answer them at the end. This is my point to say thank you very much for attending our webinar, listening to our presentation. Look for me at AVMA booth 1102 in Washington, D.C. in July, and AAEP at booth 2653 in December in Denver, Colorado. I also authored a book that gives a basic outline of the services that I provide, so that you're aware of the progression and the communication that takes involved, and also some business tips, tax tips, some SOPs, standard operating procedures, an outline of, employee handbook. It's not inclusive, but it does give a good outline of what to expect. If you're interested in the book, we'll have the live link in the slides that you'll receive. Also has the live link for scheduling with me to set up a complimentary conversation to say, hey, does it make sense for us to move into a discovery meeting, which is also complimentary, and it gives you time to really talk about your practice and what your goals and where the pain points are. And at this point in time, I'm going to turn it over to David, and I'm going to stop sharing my screen.
Excellent. Well, you should be able to see my screen now,
Yes.
with luck. Um, so my name's David McCormick. The CVA after my name is Certified Valuation Analyst. So I'm a business appraiser. I only work with veterinary practices. I've been doing this since about 2000. I'm not a veterinarian. My partner initially was my father, Larry McCormick, who had two practices in State College, PA. And in 2000 started doing consulting when I joined him. Tonight's session is on practice value, but it's more of a primer. Kind of what is it, why, where does it come from? And I hope a couple of those, really? Moments for you. So my email address is here on the screen. I don't charge for phone calls and emails, so you're welcome to contact me. If you have questions as we go through this, you can use the chat box or the question and answer box. We'll try and monitor that. But sit back and listen. They, especially for those of you on a small screen or watching this recorded, afterwards we can get, as Holly said, we can get you the slides. And I want to thank her for having me come in. So when it comes to practice value, first, what are we talking about? There's fair market value, investment value, or synergistic value. What about potential value? As a valuator, when I say value in my head, I'm being very specific. Fair market value is the level playing field. Any buyer can buy a practice at fair market value, and the veterinary lenders will provide 100%. Well, the veterinary lenders will provide the financing. Buyers do get 100% financing on the practice and the real estate. Investment value is not a level playing field. So investment value is a price, and each buyer can want it to a different level and be willing to pay a different amount based on the synergies that they bring with them and their excitement for it. The potential value, because I talk with a lot of practice owners. Oh, I'm only open 3.5 days of the week. New owner can open up 5 and grow and expand. Yeah, the fact from a market's perspective, the buyers say, no, if I'm going to do the work, I'm not going to pay you for it. You want to get paid for the potential? Great. You actualize it, show me it works, and now I'll buy it. But potential doesn't have dollar value, has attractant value, but not necessarily dollar value. And I put the book, for those not looking at a small screen on your personal distraction device, the little logo in the corner, this came out in 1969. Dr. Bob Lavoie, one of the early veterinary practice management consultants, the $100,000 practice and how to build it. Yeah, now I see solo practices generating 900 to 2 million as a solo. So it's interesting to see where we've come. There are many popular rules of thumb, that are out there. Historically, of course, the most popular, practice is worth 1 year's gross. Yeah, I think that was correct 25, 30 years ago. Practices were more profitable then than they are now. And before the veterinary lenders came into the profession, very much it was seller sets the price, the buyer sets the terms because the seller provided the financing. Kind of like when you were kids and you had to share a brownie with your sister, friend, brother. One cuts the brownie, the other side gets to choose. The current rule of thumb that's very popular in the veterinary space is 5 times the bottom line. And what makes it complicated, that comes from a bona fide valuation method. Except 5 times the bottom line, it's easy to remember, but most people use the wrong bottom line. Not every practice is a 5, and that phrase skips a very important step. To illustrate the dangers of these, though, here's 2 practices coming up. They're both grossing $1 million. They're both 20% profitable. Would you pay more for one of these practices than the other? What about some of these details? Does the real estate matter? Real estate is a separate asset. It's just an expense to the practice. But would you pay more for one of these practices over the other because of that real estate? What about some of the information on the community? Does that matter in what you would be willing to pay? What if practice B went 800,000, 900,000, 1 million? Practice A went 1.2 million, 1.1 million, 1 million. Last year, they're both at a million. The point being, there are other variables than simply what the profit is, what the revenues are, that can influence and do influence the value of the practice. So how do we assess? Valuators, for anything that's being valued, there are three approaches to value. There's the asset approach, the income approach, and the market approach. Within each approach, there are multiple methods that can be applied depending on what's being valued. This isn't a Simmons or a McCormick thing. This is global. In the veterinary profession, we do not do the asset approach. The asset approach focuses on tangibles. These methods are very popular for new construction, cost to build, or heavy tangible businesses, manufacturing, trucking, heavy equipment, etc. But in the veterinary space, the asset approach methods really focus on a liquidation value, furniture, fixtures, equipment, and inventory. It ignores the presence of intangible assets, the goodwill, your name, your reputation, blue sky. The traditional means of valuing a practice the last 20 years comes from the income approach. It's called single period capitalization, and that's where the phrase 5 times the bottom line comes from. So for the last 20, 25 years, that's been the common means of valuing a practice. The market approach methods, last 10 years we've been able to use. Market approach methods are based on transaction data. Many people are familiar with those through valuing your home, using comps or comparable properties, other similar homes, where did they transact? We have the transaction database, so we can go to that and say, okay, in the last 5 years, what other practices with a similar level of profitability and a similar level of revenues, where did they sell? Another method which people are familiar with through used cars. If you go on Edmunds.com or Kelley Blue Book, KBB.com, what's my car or truck worth? They're not comparing it to 10 other same make model years. They're comparing it to all the market as a whole. It's a regression method, and we have the data so we can do that. Applying multiple methods gives greater confidence in the conclusion. But it's all the market approach methods, the income approach methods are grounded in the profit, the return on owning the business. So I want to spend the next portion here talking about that, because the profit is not what's on your financial statements. Your financial statements are done for tax purposes, not true practice management profitability assessment. When you're the owner, you can pay yourself whatever you want. If you own the building, you can pay whatever rent you want, high rent, low rent, no rent. We see kids on payroll. We see the drugs and medical supplies or costs of goods sold have their cabin up in the Upper Peninsula in Michigan, or their contributions to the alumni and their vet school. We see things buried, pay for the car, pay for your cell phones. It's common. It's a perk of ownership. Is it legal? No, but we see it fairly common. Fortunately, we've been doing this almost 25 years now. The last 10 years especially, we're seeing less and less of that. I commonly see kids on payroll. Yeah, the last one made me chuckle because the owner said, "Oh yeah, my kids are on payroll." I thought, "Oh, that's nice. Are they in high school, college? You helping them out?" "Oh no, they're both married. They live a couple states away. Both taking $65,000 a year salary plus health insurance and retirement through the practice." Clearly, that makes the bottom line low, which is why it's done. But a new owner is not going to pay for that. So what's on the financials, your tax return, your profit and loss, or income and expense report is not real. It is for tax purposes, but not for profit. When I say profit, I'm being very specific. The profit is the revenues, normal operating revenues. If your practice has an apartment upstairs and that rent is included in the revenue, that has to be removed. The revenues less normal operating expenses, less fair compensation to the owner for their work in the practice, whether it's that as a doctor or manager, and less of fair market rent. Another way to consider the profit, if you own the business, but you don't work there, you live in another state, what would you get from being the owner? What gets deposited in there? What are the expenses that someone else would have? So because the financials do not reflect operational reality, we make adjustments as evaluators. That's the first step in the valuation process, is to literally line by line, are these expenses what someone else would have? We can make adjustments for two main reasons: operational and non-operational expenses. Things that, a high rent, well, I'll adjust that to a low rent. Paying for the family car, family cell phone plans. If I own that business, I'm not going to keep paying that. So we can remove those. But sometimes we put expenses in. If your partner or spouse does the bookkeeping but doesn't get paid, we have to put in a bookkeeper. We can also make adjustments for one-time expenses. So non-reoccurring elements. Now, the fact that you remodeled the lab, put in new cabinetry, bought a new centrifuge, and you just put all of those into maintenance and repair, you're not going to do that every year. Or you resurface the parking lot. Those are one-time events. That's the owner taking profit and reinvesting it. So we can remove those one-time elements. What we cannot make adjustments for, two things. One, bartering. When we grew up, the owner of the family health club had 4 or 5 labs. So in exchange for free general health care, we got free family membership to the gym. We can't undo that and count those revenues. We also cannot push back unreported cash. So if you're doing
Oh,
it, you need to stop because it sets a terrible example for your team. But that if it's not in the tax return revenues, we can't put it back. So stop doing it if you are. The profits themselves. Holly mentioned it a little bit. Here's a little bit more information. This is where it shakes out. If you think of a bell-shaped curve, right, that hump in the middle, the average practice is 10 to 12% profitable. That means half of all practices are 10, 11% or less. And that's scary. We consider a practice to be financially healthy if it's 14 to 18%. Exceptional profitability, 18, 19, 20, 21, it happens, but it's only 1 in 20, 1 in 25 practices are able to attain that level of profitability. And that's part of our passion in doing valuations and recommending every practice should be valued every 3 to 5 years. Because if you're down here, diagnostically, we'll know why and can get you started with treatment plans to improve your practice. The number one financial disease and why the average is so low is inventory management, your cost of goods sold. That's the pain point for most practices, especially as you get into the more large animal a practice does, the higher that cost of goods sold goes. And so managing that is key. We don't have time to really drill down into all the details here, but what's important is that what's on your tax return is not giving you accurate feedback within there. So translating this to value. Now, keep in mind, this is me diagnosing over the phone, right? That's a no-no. If you are average, in general, if you are 10 to 12% profitable, your value most likely will end up as a percent of revenue falling between 45 and 55% of revenue. So half of you watching this, your practice is worth 50% of revenue or less. Financially healthy practice, 14 to 18%, typically will end up having a value once determined fall between 65, 85% of revenue. Maybe 90, it depends on the details. But that's why this is important and why getting your practice financially healthy is key. Couple comments on this. Profit, when we assess it as if debt-free. No leases, loans, liabilities, no owner perks, no tax strategies. So it's possible to have a profitable practice that's cash flow poor, that's leaning on credit cards, having to do line of credit, etc., because of the difference between that. The cash flow includes the owner's car and kids on payroll and buying your home farm supplies through your small animal practice, paying for your horse habit, etc. That impacts cash flow, but it may or may not impact profitability. The other component, and Holly mentioned this term as well, EBITDA, earnings before interest, as if debt-free, before taxes, before depreciation and amortization, which are tax entries, not real money spent. EBITDA is an assessment of profit. It's different from a valuator's profit. It's definitely something that's in the eye of the beholder, especially when we start looking at corporate pricing, which is investment value. Every corporate group is going to come up with a different EBITDA for your practice, and that plays a role. To help you remember the acronym and a little evaluator humor, EBITDA, also the name of the office cats you've seen. Well, that's Ebbet right here. And his sister Da. When they were kittens, they were sleeping on my lap in the picture. So evaluation itself, kind of trying to bring this in so that we can have time for questions. The valuation, when you select a valuator, my recommendation, definitely find a veterinary specific valuator, someone with the credential, certified valuation analyst, CVA, which is what I am, CBA, certified business appraiser. By having those credentials, we're held to a certain level of analysis and reporting. Without that, I think you might not be getting accurate methodology. Typical valuations going likely to cost $2,500 to $5,000 or $6,000. So, and it's worth it if it's done right. But you want to tell them when you're doing it for management and planning purposes, make sure you're telling the valuator, I want the feedback, not just the price. That value, I want, what did you learn? Preferably, as I mentioned, veterinary specific so that they have an understanding of the veterinary profession and what's usual and customary as far as these expenses. The valuation starts with the proper methodology, and that comes to a number, a conclusion. The good veterinary valuators, appraisal, value, synonyms, but the good valuators are also going to do 2 reality tests to make sure their conclusion is fair market value. Does it reflect the market? Looking at it from the veterinary lender's perspective, would they loan the money? Based on, which is their assessments based on the profit relative to the debt service. Also a hypothetical buyer. And this is important for future owners listening to this. And the reason why you can get 100% profit or 100% financing. If it's fair market value, the profit only will pay the debt and pay the taxes. You do not need to use your doctor compensation to do that. The rent that the practice pays for the mortgage. So everything pays for itself. As a younger doctor that has student debt, if you're living within your means, that means your doctor compensation is paying your debt. So if your doctor compensation is paying your debt and your household expenses, the profit pays for the practice, The rent pays for the mortgage. It all pays for itself. If you're an owner, whether a practice is worth $100,000 or $7 million, you can do it if you're a future owner and are called to ownership. And what's most impressive, I think, and why we have veterinary specific lenders, less than 0.5% of veterinary acquisition loans default. 1 in 200.
Wow.
Second lowest default rate of any small business. We're second to chicken farmers. I don't know why. Maybe because Purdue and others are behind it. But that's kind of the overall process. The practice value once determined, this is called the enterprise value or the asset value. It's the value of the business. It is not the value of your entity. So it's not the number you would take 25% of if you're doing a buy-in. As the value of the business, it includes everything that was used to generate the revenues, which results in the profit that drives the value. So the determined value includes all the furniture, fixtures, the equipment, the trucks, if there's a mobile component, unless you're paying mileage. It includes the inventory at normal operating levels, the website. It includes all the goodwill. And then in a transaction, it includes a non-compete covenant that is larger than an associate level, and it is enforceable because of the dollars involved. So you have to think about everything that's in there. One more category here to hit through on investment value, just to compare through that, because the corporations are buying practices, and there are many practice owners who have an offer from a corporation, then they turn to their associate and say, here's a price. I had it valued. No, you didn't. Fair market values that level playing field. Investment value, as we mentioned, is specific to that buyer. The way it translates relative to profit or EBITDA, fair market value, 5 times the bottom line. Well, it's actually about 4.5 to 5.5. Investment value, we're getting offers on practices we're selling right now, ranging from 9, 12, 13, 14 times the bottom line. So 2.5, 3 times fair market value. That's why people are selling corporate. Now, if my value is $1 million, I can sell it to you for $1 million, or I can sell it to them for 3. Gee, what am I going to do? And fair market value buyers cannot compete. So I'm not encouraging corporate ownership, but I think you really do need to pay attention to that difference within there. There's all kinds of strings attached as well. We could do an hour just on corporate or an hour on fair market. Uh, so I do recommend within Simmons, we do valuations, yes, for transactions, for estate purposes, for buy-ins, but half of our valuations are purely for management and planning purposes. And I advocate every 3 to 5 years on an ongoing basis, have your practice valued. You recommend annual wellness exams. This is your financial wellness exam for your business, and get that feedback. You want an objective appraiser. You don't want somebody blowing smoke, a high number or a low number. And this just talks about what I had mentioned already. If you're seeking a valuator, don't just go with the one that you heard speak. Look at several. I recommend pulling from the Vet Partners Valuation Council. We're on the council. It's myself, Sherry in my office, and 25 friends, colleagues, competitors, all of whom are veterinary specific credentialed valuators. Names you recognize, Karen Felstead, Denise Tumblin, Tom McPherson, Glenn Hanner. There's a lot of us. And at that level, you're getting a commitment and an understanding of the veterinary profession. The Valuation Council also published Valuation Essentials for Veterinarians as a PDF. If you send me an email, or I'll upload this here as part of this, it covers more of what we're talking about here. It does not teach you how to value. That's not the intent. It's to help you become an educated consumer of valuators. Another resource for you, um, The Profitable Vet. Full disclosure, I'm one of the authors and Sherry in my office as well, but this was done with Karen Felstead, Leslie Mamelis, Dr. Dick Goebel, and Nancy DeWitts. So it's available on Amazon. It came out last fall as a resource. We just saw a lack of financial books. And AHA stopped publishing texts. It's also available on the AHA website now. So we put this together. My contact information is here. Phone calls, emails, happy to respond to any questions that you might have. Um, and we'll go through that. If I don't know the answer and you email me a question, I'll know several folks that I can send you that can help. So I hope you got something out of the time here that made it worth paying attention, whether you're here live, thank you for being here, or watching this recorded. And again, thanks to Holly for putting this together. I think practice management education is so hugely important. I just wish Pennsylvania would start allowing you to use CE practice management hours for your license. I'm working
Yeah.
on
But thank you so much, David. I really appreciate you contributing your time to be here to talk to our veterinarians and provide your knowledge. I mean, you have a wealth of experience, and we've worked together before, which was wonderful. It's pain free.
that.
So I'm looking for some questions in the Q&A, and those folks that are here, please drop them in. But I did actually have a couple other questions for you, David, that might help open up the some other thoughts. You mentioned the general cost for the valuation. What is the timeline involved? How long does it take to do a valuation and so forth?
Yeah, we try to work quickly, but we want to be right more than we want to be fast because our clients are making decisions based on what we tell them. Once we receive the data, it's typically 6 to 8 weeks. Much of that timeline depends on how well it's organized. Like you mentioned, good chart of accounts, good clean bookkeeping, speed things up. But if we have questions and it takes you 2 weeks to get the answer, yeah, it adds time to it. But it is worth, I walk through the exhibit halls, there's folks saying free valuations. Well, they're just skimming practices looking for a corporate that they can convince to sell. And
Right.
you're going to get what you pay for.
Right. It's having a practice that's maybe more modern or better equipment, or new trucks, whatever it may be, ambulatory. And how does that affect the valuation? And then because we talked about the bottom line times, and then the building as a component. Do you actually value the building, or do you get a real
No.
estate appraiser, or how do all
Yeah.
those things work?
Yeah, the real estate has to be valued separately as a separate asset, and every state licenses real estate valuators. Although, as a practice owner, you don't necessarily need a real estate appraisal. Oftentimes, you can fine tune it enough working with local commercial real estate agents. If you are going to go that route, what I recommend, they're going to look for comps, so other similar properties and where they've sold. They should look for comps that are not veterinary. Veterinary real estate is not worth more because it's veterinary unless it's new construction or less than 5 years old or so. And if they find anything, it's likely to be in a different market. So I recommend if you're working with a real estate agent or an appraiser that they should be looking for other professional office space. So dentists, chiropractors, attorneys, architects, that more likely than to find similar properties in your market and come back with a range. But a range is fine for planning purposes or even a transaction. I think the relative to equipment, how nice your facility is, not to be cold, but it's not what you have, it's what you do with it. If the
Mm.
ultrasound is
Mm.
sitting under its cover and it's getting dust,
Yeah.
yeah, you have an ultrasound, but you're not doing anything with it. You need to be utilizing that to generate revenues. Now, I teach a workshop on self-diagnosing, assessing your own practice's financial health and the main diseases and developing treatment plans. One of the key components, I think, especially for new practice managers to understand, and every practice owner, we are in a fixed cost business. And which means the majority of your expenses, when you think about it, your support staff, all of your facility costs, your insurances, your office expenses, don't change. Whether you see 8 clients today or 18 clients today, those expenses don't change. To drive that point home, if for a small animal practice, if you add one more dental procedure tomorrow, you're going to have all those revenues. The office cats went in, it was $1,100. Da had 7 teeth extracted. One more dental procedure, you generated $500, $1,100. What have your expenses changed? Drugs, that's the variable expense. A little doctor time if you pay on production. That's it. Your last client is your most profitable client. So the benefit of being a fixed cost business, how can we practice more medicine with the same assets? Can we work smarter? Can we change our protocols to fit one more client in? Now, as a motivator for the practice manager and for the owner, yeah, that's key. How do we do more? But that doesn't motivate your team. So good business has to be translated to good medicine. The team meeting is, team, we are good at what we do. How can we change our processes? There are animals, dogs out there, cats out there that need us. How can we change our protocols so that we can fit one more in? One more every day. More
Right.
revenues, more profit, more value with the same asset base. The value of the practice goes up. Products are not they're great revenues, they're not great profit. So you want to shift your practice over into more services, more medicine, which builds relationships, which becomes preventive care. The big 3 areas I talk to people about growth, certainly cats, way underserved, nutrition, and oral health. The problem that we're seeing from our clients, though, everyone's running at capacity. The thought of adding one more dental procedure is not appealing because we can't fit them in. We can't find doctors to add capacity. We can't find technicians to help work smarter. So it becomes this catch-22 when you're running at that point. Um, they see the path, they just can't get on it.
Yeah, and I talk about that with operating procedures, having things systemized, routinized, written down, that it's the same for everybody, making sure that the doctor is doing what the doctor should be doing, the techs or assistants are doing what they should be doing, and that everybody's
Delegate.
on this, everybody's on the same page, because having those procedures, gives the employees a reference, in case there's a question, it's less interruption on your time. And that's the whole part of running efficiently. It's not always the financial side of it. It's, using your time to the highest and best use to make sure that, if you can fit in the extra revenue and the patients, it's a win-win.
Yeah.
Yeah.
Yeah, for sure. The doctors should be doing 4 things only: charting, prescribing, doing callbacks, doing surgery. Anything else should be delegated. If you have licensed, registered technicians, they should have an assistant so they can share it on over. So you're utilizing the whole team. Big fan of
Right.
tech appointments. And when everybody's being utilized, they feel a part of it because they have responsibilities. They've been empowered,
Right.
not to go down the rabbit hole, but distributive leadership, right? Servant leadership programs instead of the hierarchical, I'm the boss, do what I say.
Hmm.
Empower the team because then you can do more and it's to everyone's benefit, including the pet and the pet owner, which, they're a big part of this.
Yeah, absolutely. And sometimes routinizing or using those routinized procedures that don't necessarily need to be done by somebody frees up, you can automate it. Do you have online booking? Do you have, and I think there's even some good for ambulatory practices out there now. Is it integrating well with your practice management software and looking at these things behind the scenes that can also build greater efficiency, free your time up. But hey, what other things that can either help increase the value of the practice and or dovetail. If you're looking at 3 to 5 years of into selling the practice, what are some tips and advice that you might have for practice owners?
Well, certainly, the best time to plan your exits when you're planning your entrance. The second best time to plan your exits today.
Mhm.
So even if it's, if it's 3 to 5 years out, if it's 10, 15, 20, that fits into that. Have you had your practice valued? uh, so that you can make decisions with full knowledge of the relevant facts. Not an estimate, not a guess. Yes, the average practice in the transaction database, it sells for about 71.5% of revenue. But it's an average. You can't use that for decision making because that means half are higher and half are lower, and size has nothing to do with it. We valued a $13 million grossing small animal practice that was 0.6% profitable. Not even 1%.
Wow.
And this was a couple years ago. We thought, oh, we're past that. No, we have an $11 million grossing small animal practice, multifaceted, that has boarding, grooming, doggy daycare, rehab, all this thing in a large compound. The owner took home $100,000
Oh,
as
where's the
the
leak?
owner. So,
Oh,
the size has nothing to do with it. And like you said, you can't manage what you don't measure. If you don't know where you are, you have to accept and you got to look before you can take action. And
yeah.
that's our passion, is trying to help people make change. Within a year, if you know what to work on, you can double your value often.
Yeah. When I start working with a practice owner, I ask them to pencil in a retirement date. I mean, if they're in their 30s and 40s, that may seem ludicrous, but you know what? You
Yeah.
have it in target, because I've actually seen practices, not just vet practices, but other businesses where they think it's either going to solve itself, and it'll be available when you're ready to sell in a year, or they're going to die doing the work that they're doing. And nobody should be, going in that direction. So definitely have it happen on
Yeah.
the calendar and move forward. So but thank you very much. I think we're just about up to time. I don't have any other questions on the panel. I did want to give a shout out to our next webinar, which is Wednesday, August 20th, talking about tax savings and contracts with our vet partner org colleague, Justin Weaver.
Oh,
Um,
yeah.
yes, Justin came out and
That'll be
spoke
a
a
good
while
one.
ago. Yeah. He talked about mergers, acquisitions, and other areas, and then we're going to be talking about contracts and things that are routinized within the practice that people need, like buy-sell agreements and
Yeah.
partnership agreements, and the things that you need to be talking about in advance of starting with a partner, so that if things go to hell in a handbasket, you have the ability to go back to that document and allow things to transition smoothly. So anyhow, we're not meeting in July because we've got AVMA and lots of fun stuff going on, but in August on the 20th, we'll be there, and be sure to sign up on the website, cbas-cpa.com. And I really, really want to thank you very much for contributing, David, your wealth of information.
My
And
pleasure.
anybody that is looking for evaluator, please be sure to speak to David. So I'm going to end the record, and thank you very much.
Thank you.